Thank you for joining and a warm welcome to this year's launch of our annual Building Products and Services publication. Today's event follows the format of that publication, which is a look at some of the key themes in the sector on the one hand, and a look at what's been happening in M&A, mergers and acquisitions on the other hand. The publication has been put together with a lot of help from leading participants in the sector as well. So we'd like to extend our thanks to them for contributing, and you'll see that when we publish that the actual publication, which I hope is next week. So in terms of this morning, we've got quite an action-packed hour. So first of all, we've got an update from the CPA, from Professor Nobel Francis, who's kindly joined us to walk through the sort of big trends in terms of volume and what's happening in the sector. Then we've got a summary of M&A findings from two of our BDO colleagues, Matt and Alan. Sticking with the M&A theme, quite a big part of that has been private equity. They've been a huge participant in buying businesses in building products and services. So we've got Pete Wood from Aurelius. They've been very active in the sector, and he's going to be working on his session with Sarah Ziegler, also from BDO. And then turning to key market themes, we've got Daniel Guttmann, who's strategy at BDO, and Simon Pringle, who leads our sustainability business. And they're going to be talking predominantly about sustainability in the sector. And then we have all of our panelists coming together for some predictions for the rest of 23 and into 24, and finally some Q&A. So on that Q&A, there is a chat function. So if you could please, if you have got questions that you'd like to post, please do post them in the chat, and we'll make sure that we try and pick up as many of them as we can at the end. Just on other kind of housekeeping, if you're having technical difficulties, just again, please let us know using the chat function, and our tech guys will try and sort that out. Just to say, a copy of the slides and a recording will be available to everyone. That will come out afterwards, and then subsequent to that, a copy of the publication itself, which we're hoping will be next week. So on that basis, I'm going to hand over to Noble from the CPA to talk about what their predictions are for the sector.
Thank you very much, John, and thanks to BDO for inviting me to this session. We published our latest construction forecasts in May, covering 30 sectors and subsectors across 113 pages. What I'd like to do is just give you a brief flavour of some of the key highlights of the forecasts, and then some of the key risks around the forecasts. And what you can see is our forecast for 2023 for this year, covering the key top-level sectors. So overall, on the right-hand side bar, you can see that we have total construction falling 6.4% this year. So it's a significant fall. It is worth noting that fall is highly skewed to certain sectors. So if we look at some of the key sectors, first of all, it's worth highlighting private housing, which we're anticipating to fall 17% this year. Most of the major house builders are focused very much on completions, while starts and land purchasing remains very subdued, except in some key selected areas where demand is held up. Demand fell very sharply overall in private housing after the mini budget in autumn, which we refer to as the Truss Quartane debacle. And overall in Q4 last year, demand was around 30 to 40% lower than a year earlier, because of those sharp rises in mortgage rates and sharp fall in sentiment for house building. There has been a pickup in demand from that low point at the end of last year, and that's occurred as mortgage rates have fallen, and house builders will be hoping that demand will accelerate from spring, the key spring selling season for housing. The key problem for them will be as mortgage rates start to rise again, given that interest rates keep rising as the Bank of England focuses on trying to tame inflation. What we are anticipating is that given the impact of higher interest rates and higher mortgage rates, we're expecting that government will give some stimulus for first-time buyers who are the ones most disproportionately affected by affordability issues and mortgage rate issues. We expect that government stimulus to potentially come in the autumn statement this autumn, so it has an effect in advance of a general election next year. If we look at public new housing, which is a 15% fall this year, the housing associations report to us that affordable housing demand has actually been broadly maintained. It's sustained much stronger than private housing demand. But the key problem for housing associations and for local authorities is that they're having to shift resource away from new build to fund issues around the existing housing stock. So that focuses on basic living conditions, building safety issues, not just cladding, but also dealing with fire doors, fire stops, and general fire safety issues, and also decarbonisation issues, because from 2025, they won't be able to make any new lettings unless their properties are EPC rated C. So that does involve a lot of decarbonisation work on the existing housing stock. In terms of public non-housing, which is broadly schools and hospitals, we have a 1.5% fall in volume this year. There are programs in there on education based around the school rebuilding program and in health around the new hospital program. Problem there is that we're seeing client hesitancy signing up to new contracts for new projects because they're concerned about the extent of cost inflation and whether costs will spiral out of control. So those are being hit by delays, and it's worth noting industrial, because industrial, which is primarily warehouses and also factories, we're seeing industrial activity is currently at historic high levels. It's been boosted by warehouses activity, clearly because of the long-term shift to online shopping that was exacerbated by the national lockdowns. And so strong activity down on the ground because of that. Within industrial, we're also seeing strong activity in factories currently, which is based around investment decisions by manufacturers in 2021, when they were capacity constrained and demand was very strong. So those business investment decisions are coming through. Commercial broadly breaks out into two key areas, two key distinct markets that we see at the moment. Looking on the major new towers project side, there's relatively few and has been for the last couple of years. And so that is what's driving the 5.2% fall. Offsetting the fall in new towers projects, we have very strong workloads in commercial on refurb and fit out of existing developments. Short term, there's a very strong demand for grade A office space from tenants leaving their properties at the end of leases and wanting to downsize into very high quality, different type of office space. Not as many desks per worker, but with more meeting room space for hybrid and virtual meetings. So counterbalancing those two, you end up with a 5.2% fall this year. It's worth highlighting private housing repair, maintenance and improvement, which is a sector that up until March last year was reaching historic highs, boosted by that race for space, homeowners wanting better quality indoor space, better quality outdoor space as well. After March last year, activity started to fall away, and that activity falling away was based around the rising cost of living, homeowners being more uncertain about economic prospects, about job prospects, facing falls in real wages. So what households were doing from March last year onwards was just pushing back or cancelling any small discretionary RM&I work. What was sustained last year were the larger improvements projects, because most households that were looking to do those projects had the planning permission and they penciled in the finance for those projects. New applications for those projects, though, fell at the end of last year. And so what we're expecting is that fall in applications for larger improvements projects in the home, that's likely to feed through this year. However, it will be offset by two key areas of strength within private housing repair, maintenance and improvement, and that's energy efficiency work, such as insulation, and solar photovoltaic work, which has grown considerably since summer last year, particularly as energy security and energy price issues have become increasingly prevalent. So if we move to the next slide, what we have here is our forecast for next year, and underlying this is stronger economic growth within the UK economy. We're expecting inflation to slow, which means we get real wages increasing. And we're expecting some of those public sector projects that were delayed this year to actually feed through next year as well. Overall, we have a 1.1% rise in total construction, but it's worth noting that's driven primarily by private new housing, rising 4%, which is the largest construction sector. Second largest construction sector, private housing, repair, maintenance and improvement. As real wages rise with a strong labour market, economic growth, we're expecting that to rise by 2% as well. But the notable figure in this is the industrial sector, where we have a 15% fall, which clearly looks very sharp, but that's because it's coming from historic high levels. And those historic high levels of activity that we have down on the ground this year are likely to suffer from the fact that investment in warehouses appears to have peaked at the moment. And within factories, those investment decisions that drove growth that were made in 2021, manufacturers were not making those investment decisions last year. Most manufacturers tend to sign off investment plans in around autumn for the year ahead. And autumn was when we had the economic and political uncertainty due to the mini budget. Okay, so if we move on to the next slide, then it's worth highlighting very briefly some of the key risks around. And most of the construction risks still lie on the downside, but there are some positive ones, so it's worth noting those as well. So overall, compared with 3 months ago, 6 months ago, the UK economy and consumer spending has held up better than expected, particularly from homeowners and consumers who've benefited from having help on the energy bills, which were expected to hit households very badly over the winter period. So if the UK economy and consumer spending holds up better than expected this year and next year, we could see that benefit housing and particularly repair, maintenance and improvement, which are the two biggest sectors. There is a concern about the impact of further rises in interest rates. We assumed in doing our forecast that interest rates would have peaked already, but after the latest inflation data, the markets are anticipating that interest rates will rise to 5.25%, which would clearly impact on households, particularly homeowners with mortgages, and it would impact potential new homeowners as well, so impact private housing demand. There was concern about a financial crisis a couple of months ago based around issues for Silicon Valley Bank and Credit Suisse, but further regional banks in the US expected to encounter issues. We're not expecting a financial crisis to occur, but if it was to occur over the next 12 to 18 months, that will clearly impact on mortgages, credit, and insurance cost and availability. It's worth updating you on materials and product supply, which was a very big issue in 2021. For most products and materials, those issues have eased. There are still some issues based around microchip related products such as boilers, EV chargers, heat pumps, electric smart meters, but otherwise there's a specific issue around plasterboard, but otherwise those issues around materials and product supply have eased. Materials price inflation I'll get to in a minute and show you a couple of charts, but labor availability and cost is still a major issue for some major contractors. If we move to the next slide, then it's worth very briefly highlighting the issues around materials inflation, given that this was one of the key supply issues last year. Materials inflation, so the annual percentage change in materials prices, peaked at 26.8% in summer last year after the spikes in energy, oil, and commodity prices impacted materials prices after Russia's invasion of Ukraine. But we've seen since summer last year that the rate of inflation has slowed, and it was still double digit up until February this year. But on the latest data in April, materials inflation has slowed to 4.7%. But if we move to the next slide, that just means the rate of inflation is slowing. And if you look at materials prices rather than the rate of price increase, then materials prices have been increasing in the last 3 months. And overall in April, materials prices were 43% higher than they were in January 2020, pre-pandemic. Okay, if we move to the final slide, what I'd just like to highlight as a summary overall is that construction activity is still very strong overall. This isn't 2008. Construction activity returned to site after that initial lockdown in 2020 very quickly and has been above pre-pandemic levels for the last 2.5 years. Private housing new build and private housing repair, maintenance and improvement are falling significantly, albeit they're falling from a very high level. And then it's worth just finishing on the key areas of growth for contractors, which is major infrastructure and frameworks, which are those major infrastructure projects, particularly Hinkley Point C, HS2 projects that are down on the ground, HS2 phase 1, and the Thames Tideway Tunnel, and frameworks from the regulated sectors of water and roads, rail, etc. Commercial refurb continues to be very strong, and not just short term, but long term, it will be very strong because of the worry from commercial property owners about stranded assets. Energy efficiency and solar photovoltaic remains very strong, and then health will only increase over the next few years because of that new hospital program of 40 new hospitals as that feeds through. And if we move to the final slide, then if you don't get the chance to ask any questions during this Q&A, and hopefully you will, then you can always contact me on these details. And within Twitter and LinkedIn, I tend to post the latest market intelligence, so that may be of help to you as well. And I'd like to hand back to John now.
Thank you very much, Noble, for that. Very, very informative, as always. And I guess being on our side, being sort of mergers and acquisitions people, we're probably focusing more on 2024 than on 23, which starts to look a bit better in terms of the outlook. So on M&A, we're now going to move to Matt and Alan from BDO. We're just going to give you a very quick walk through what's been happening in the deals world.
Thanks, John. Yeah, very much looking at historic performance here around M&A within the sector. So 2022 saw record deal volumes again, both in the UK and internationally. Given the almost 70% surge in volume in 2021, it was impressive to see activity hold firm pretty much worldwide. The US was once again the most active market, accounting for just over 40% of all global deals. The UK again is a incredibly strong and attractive market, holding that second spot in terms of deal volume, about a quarter of global deal volume being done within the UK or by UK-based companies. Within global deals, there was a notable rise in cross-border activity. So 24% of deals attracting overseas buyers. UK buyers, interestingly, also stepped up their international activity. So there were 39 deals completed by UK buyers internationally in 22, which was almost double the 22 seen in the previous year. In the US as well, interestingly, the proportion of businesses sold to overseas buyers was also up by around 74%. So again, some international exposure there for US businesses. And moving through into the UK market, we saw deal volumes again increase by around 3%. Holding elevated levels that again we saw in 2021. So again, real sort of record volumes within the sector. And across the M&A world, we saw across all sectors, the UK market actually declined by 10% in 2022. So the sector was very much outperforming the wider M&A market, and it appears, again, it continues to appear attractive. I think as we're emerging from Brexit, the pandemic, and businesses that have really been under huge pressure with various market forces and instability. Noble, you touched upon the price instability as well. It appears that both confidence within the UK market and from international buyers into the UK market is returning, and the UK is very much seen as an attractive market. In terms of the different types of deals, services businesses again remains in high demand. 44% of total deals in the UK were in that sector, and particularly compliance related businesses. So fire security, for example, there are a number of deals done within that sector. Again, businesses extending geographic coverage, increasing range of services, and combining essentially to get that economies of scale and synergies through M&A. So Alan's going to take a quick look at the valuations within the sector.
Okay. In terms of valuations, what we've seen in recent years is a period of high valuations, predominantly driven by kind of recent activity, kind of glut of transactions coming through following the pandemic, and also strong listed markets. In 2021, 2020, business had to get to grips with the pandemic, readjust. So there was a kind of a temporary hiatus on kind of transactions, but once markets kind of generally reopened, there was a glut of deals getting done through pent-up demand, and this kind of created a environment where there was kind of strong valuations being supported. More recently, a combination of business factors, macroeconomic factors have seen valuations settle back to more normalized levels, so in line with longer term averages and pre-pandemic levels. So on the left, you can see the averages. So, the listed multiples are now back to 7.9 times. This was compared to well over 12 times same time last year. Private markets have followed the trend, but not necessarily to the same degree. So the average multiples in 2022 were 6.9 times. This was a drop from 7.7 in 2021. And interestingly, private equity have also been shown their ability to compete with trade for attractive assets. So they averaged 7.3 against 6.7 for trade in 2022. So on the next slide, we have a look at the valuations across the different subsectors. There's kind of 6 subsectors which held in line with kind of prior year, and there were slight increases in building materials, HVAC and electrics, while there's slight dips in kitchen and bathroom merchants and distributor multiples. So importantly, what we've seen in terms of themes on valuations, we're still seeing a lot mixture of completion accounts and lockbox. Different approaches have different benefits, but in some instances where if there's a little bit of uncertainty, there have been the completion accounts method pursued, just gives a little bit more clarity and protection from buyer's perspective. Fundamentals remain important, as you imagine, but a little bit more focus on the COVID impact. So normalizing that, and actually, is there data or kind of the analysis to prove what some of the adjustments are or the non-COVID impact. And also what we have seen is a number of deals with earn-outs. So again, with the uncertainty, these are go-to mechanism to provide a bridge on value expectations. So in summary, valuations have returned to more normal levels pre-pandemic, following kind of glut of activity. What's important is arriving at a shared view between buyers and sellers, because there have been quite a number of exceptional costs and events in recent times. So it's just analysing that through and having the data to support. Thank you.
Thanks very much, Matt and Alan. I mean, it's interesting that notwithstanding Noble's economic sort of impact for 23, how the deal market has kept going, in this sector. It's just amazing levels of activity. Despite a headwind or two in some of the areas like house building. Indeed, in house building, we've seen a couple of private equity investors come into regional house builders. So, they're taking a longer term view. They haven't been deterred by the short-term softening in that particular market. So the other big feature of private equity, and we're going to turn to that now with Pete. We're delighted that Pete from Aurelius has joined us, and Sarah from BDO. There's 2 types of private equity deals. There's those that are from private owners selling their business, and there are corporate carve-outs, and Aurelius have got a sort of specialism in corporate carve-outs. So over to you both.
So the headline really here is that private equity investors still remain really attracted to the sector. In 2022, private equity completed 142 deals in the sector, which is just slightly down on 2021. It represents 37% of all deals completed in the sector in 2022. As you can see from the chart here, levels are roughly double those seen before the pandemic. This follows a period of rising investment over recent years, with investment in the last 2 years being particularly strong. In terms of sectors, half of all deals in the last 8 years in the merchant and distributor segment have been completed by private equity or by trade players which are backed by private equity. And then turning to 2022, the roof, cladding and installation market has seen both a surge in volumes and a surge in investors, with 44% of deals receiving private equity backing. Security and access is another hotspot for PE investment, who backed 40% of deals in 2022. This is also the sector that is attracting the highest valuations currently. And as touched on, fire and security is a hot theme for the rest of 2023 as well. Carve-outs are quite a major market feature in terms of private equity investment at the moment. We've seen a good number of major corporates in the sector reshaping their strategies and portfolios over recent years and selling non-core businesses to achieve this. We've got a few examples here on the slide, just some of the carve-outs that have taken place in the last 2 to 3 years. Saint-Gobain has been particularly high profile in this regard. as well as selling ceramic tile distributors to Aurelius last year, which you might be able to tell us a bit about. The business exited all UK distribution brands, disposing of Jewson and Stark Group, which is backed by CVC Capital, Ideal Bathrooms to Wolseley, which is backed by Clayton Billier and Rice, and International Decorative Services to Chiltern Capital. Travis Perkins sold tile giant coverings, Prima Flow to Newbury Investments, and most recently its plumbing and heating business to HIG Capital in a 325 million deal. Consolidation plays are also common here. For example, the builders merchant Hughes Gray, that initially received investment from Flexion Private Equity, has been a prolific acquirer of small businesses, received backing from Blackstone in 2021 and went on to acquire Grafton's UK merchanting brands in 2021 in a 520 million deal. And Wolseley have been carved out by Ferguson and acquired by Clayton, de Villiers and Rice, that went on to acquire part of Graham Plumbers and IDSL from St. Gobain. And a further example is ceramic tile distributors, which, having been acquired by Aurelius, took advantage of the opportunity to acquire a number of branches from Tile Giant. So I think really the key point to note here is the vast majority of these deals are going to private equity acquirers. So I'm pleased to have Pete Wood from Aurelius here to tell us a bit more about these dynamics. Pete, are you there?
Yes.
Great. I know that carve-outs, thank you for joining us. I know that carve-outs are in general a big theme for Aurelius. Why do you think that we're seeing an increasing propensity for corporates to undertake carve-outs?
I think there's a lot of pressure on corporates and a lot of a focus on making sure that the strategy is very focused. So the kind of institutional investors, activists, shareholders are really keen that there's a clear focus on what the mission of the business is. And if there are businesses that are not aligned with that, then it's a clear candidate for potential divestment. And I think the objective there for the business and the management there would be a re-rating of the overall share price if the story is good. And from a Saint-Gobain perspective, their strategy is to focus on making and selling products which make the home more energy efficient. And so when they looked at their ceramic tile distribution business, it didn't fit with that strategy, and hence was core non-core for them, and they decided to sell it.
Right. And why a private equity?
But I think
so interested in all these assets.
So I think there's two different categories. I would say mainstream private equity are interested in kind of growth areas. As Alan and Matt discussed, there are various growth niches within the segment, which include fire and security, insulation-driven, smart buildings, smart homes, areas that are clearly got fundamental market growth is interesting to private equity, as are those that have higher margins. I think those that are less exposed to cyclicality as well, so more RMI or maintenance-driven businesses, businesses that are focused on testing, inspection, and compliance, they're definitely the hot areas for mainstream private equity. As are those that are perhaps a little bit less exciting, but have a consolidation play opportunity. So some of the deals that you mentioned in the merchanting space have been doing buy and build plays where they can grow despite a relatively lower growth market that they're in, and buy for a lower multiple than the overall business is worth, derive some synergies and create some interesting returns opportunities. From an Aurelius perspective, we're we're a little bit less picky when it comes to the opportunities that we pursue. We're a situational investor looking to provide corporates with a solution for non-core divisions, and some of those divisions may have not had a lot of focus in the past, and hence may not be as attractive to mainstream private equity. And we're able, with 150 of our operating partners and people in the team, to take on those businesses and make them core to us, and improve them, and hopefully by the time we come to exit, put them into that interesting, exciting, more exciting category by the time we come to sell.
Yeah, that's great. Are there any insights you can share in what your plans are with any particular businesses that you have invested in the sector? Yeah,
absolutely. So we bought, sticking with CTD for a moment, the business has 5 distribution centers for the size of business, which is too many, and because it was non-core division, they hadn't focused on those kind of operational factors. And so we'll be considering whether it makes sense to bring together the distribution into a kind of a single or a fewer number of hubs. We'll be investing in digital, improving the click and collect, improving the online offering to be able to become kind of best in class from that perspective. We'll be doing some selected kind of buying of other businesses in the space, and we'll look at store rollout as well. So it's a combination of what you'd expect, making sure the business is running efficiently as possible, while also looking at all the different growth avenues that we have. From we also own a business called Zentia, which is a fiber-based ceiling manufacturer based in the UK. The business we bought was very much focused on wall-to-wall ceiling tiles and systems, and we will be we have launched a new floating ceiling offering, which is very much kind of driven from a web based design platform, which enables a lot more customization of the ceilings in different shapes and colors and sizes and arrangements, and so you're really bringing a bit of innovation into what was already a very good solid business, but to take it into a new category required CapEx investment in people, technology, and so on.
Brilliant, thank you. I think that's really helpful for sharing your insights with us. Thank you. John, shall I hand back to you?
Yeah, thank you, Sarah, and thank you very much, Pete. I mean, I think that's fascinating. I mean, for people sort of owners of businesses and the like, who maybe think of private equity as money and the sort of financial equation, there's an awful lot of value-added stuff going on there, that Pete's talked about in terms of innovation and working with the management teams to, bring change to those businesses. So I think that is really, really interesting. So we're going to turn now to some of the key market themes, and we've got Daniel and Simon, who are both at BDO. The publication looks into quite a few of these. So just on the next slide, we've got clearly there's a lot of regulation coming through with the Building Safety Act. We've seen a lot of innovation in materials now starting to appear, sort of decarbonisation of some of those materials like concrete. Modular build, continues to be a big thing, and supply chain, e-commerce, labour shortages, some of the things that Noble touched upon. What we're going to focus on here is the emissions side and sustainability. So Daniel and Simon are going to walk us through that for the next few minutes.
Yeah, thank you, John. So John and several of the previous speakers have already talked about energy performance, energy efficiency, etc. And the building stock is a really big constituent of that, and that's a topic that we would like to spend a little bit more time on over the next few minutes. If we can go to the next slide, please. So just to set the scene, the built environment is a huge contributor to UK emissions. So just heating and powering buildings is about 40% of UK energy use. And if you just take the residential side, that's almost 20% of emissions out there. So there's a lot to be done, and addressing that will go a long way to helping reduce emissions in the UK. if we can go to the next slide. So we do read an awful lot about energy saving schemes, funding, new technologies, insulation, etc., and obviously the need to reduce emissions. But when you look at the data, actually the picture isn't quite as positive as one might expect. There's two lines on this chart that you can see. The top line is overall UK emissions, and they have fallen quite substantially by about 30% since 2012. The majority of this has been driven by decarbonization of energy production. So the advent of wind power and solar power has driven that very strongly. The bottom line, however, is residential, and actually that has been almost entirely flat if you take out very cold winters at the beginning of that period and an energy crisis at the bottom of this period. So this is quite a sorry picture when it comes to decarbonization of our housing stock. The good news is that technologies and materials exist, and there's a lot of innovation that is going on, and Simon and I will be talking about that as well. But it's also complicated. If we can go to the next page, please. So just to set the scene and just to stick with residential for a second, we have about 28 million homes in the UK. It is the oldest housing stock across Europe. It's also the least energy efficient in Europe. And by some estimates, the number of residential buildings that have a EPC rating of C or better is about 50%. So there is an awful lot of work that has to be done, partly to stick with regulations that Noble was talking about in terms of 2025, but partly just in general to bring emissions down. And the complication is that every building is different and no one size fits all. So a lot of work has to be done. I guess the good news is we know what needs to be done. The challenge is to get it done. And if we can go to the next page, we've identified a number of key factors to help with that transition, to make that achievable. I do want to leave some time to speak with Simon as well and bring him into the conversation. So maybe just highlighting a couple of points. One is complexity. There is an awful lot of schemes out there. Some have been successful, some have arguably not been very successful at all. There are lots of different funding eligibilities, lots of different channels. Responsibility and administration and execution of these schemes is very devolved and complex. So this needs to be made simpler in order for consumers to understand what's available, for business to understand how to navigate it, for local authorities to know how to operate it. So there's a lot of simplification required. The second point is access. We are living in a resource-constrained world, and therefore choices have to be made, and that makes sense. A lot of the schemes that are out there are very rightly aimed at lower income households, and that is right, and especially in a cost of living and energy crisis, that is very fitting. But nevertheless, low cost households are, or low income households are a small proportion of the overall entire residential housing stock, and middle classes do equally not necessarily have thousands of pounds to spare for improvements, and some of these improvements are very, very costly. So if you take a heat pump, that could be in the tens of thousands of pounds. So something that policy makers will have to grapple with in the coming years. And finally, the final point I would like to make is around consistency of policy of programs. So what I mean with that is, just to give you an example, if we want to hit the targets that government has set for heat pump installations, we probably need 10 times more heat pump installers than we have today. Ramping up that training, including recruitment, ramping up supply chains is a big investment for businesses out there. And in order for that investment to happen, there needs to be a climate of clarity, stability, and trust. And I still remember, and many of you might remember, the kind of boom and bust days of the early days of solar feed-in tariffs, when everybody went on a huge investment drive, feed-in tariffs were suddenly cut and everything disappeared again. So that is something that hopefully will not be repeated, and I'm sure government has learned from those lessons of those early days. So maybe this is a good time to bring in Simon. Simon, I talked a lot, and we talked a lot about building materials and the importance of innovation to make energy reduction work. What can we learn about the future of building products from the experience of other sectors?
Well, that's a great question, Daniel. Thank you. And it kind of ties back to some of the other presentations that we've had this morning as well, I think. I think the mindful of time, but I think the biggest lesson is the way in which the building product supply chain is likely to be influenced is going to be directed by those, particularly within corporate, from a corporate end user's point of view, the way in which it embodies the commitments they're making, and we're really looking into the supply chain, into that scope 3, to keep the promises that other brands have made already. And we've seen that within apparel, we've seen that within food and drink, we've seen that within other sectors as well. So the definition of brand by the head of the value chain cascades down into all supply chains, and I think we can fully anticipate that being a theme over the next 2 to 3 years. Scope 3, both from an emissions point of view, but also from with respect to biodiversity and social impacts, has been a can that's been kicked along the road a little bit over many years. But now it's where the focus is from a corporate reporting and transparency point of view. And as I say, we've seen that through the experience of sectors that have been a little bit further to the front of that agenda over the last sort of 2 to 5 years.
Okay. No, thank you, Simon. Really interesting. Maybe 2 more questions, just in the interest of time.
Sure.
Can you talk about why embedded carbon is so important for developers and then occupiers?
Yeah, well, it links to what I was just saying there around that that sense of scope 3 and the full disclosure of the impact that investment decisions around the built environment have. So we're seeing that shift now, not just in the UK, across lots of European and beyond markets, from what was previously an emphasis on operational carbon. So what is the efficacy of this building, this asset, whatever it might be? Again, I'm speaking more about commercial and industrial assets here rather than domestic, to a demand that's driven both by investors and external stakeholders to understand the full life impact of the decisions that have been made and the development that has been brought forwards. And that requires a good understanding of embedded carbon. That, of course, requires real engagement with those organizations that are critical from a supply chain point of view. That's about data clarity and about the evidence that underpins the claims that are being made and so on. And it sort of cascades upwards. You can't cascade upwards, can you? You know what I mean? It escalates from that perspective in terms of from a reporting point of view.
So we've heard about, I guess, a burning platform for it all, a willingness to make it happen. What in your mind are the kind of biggest barriers to the adoption of more environmentally friendly alternatives in the supply chain?
I think it comes back to the presentation that we've just heard, actually. A lot of it is around skills and kind of traditional mindsets in terms of saying, well, we know how to use, let's just talk about the structural materials. So we know how to use concrete, we know how to use steel. Do we know how to use timber? Is there a consistency in terms of specification around newer products? Have we got clarity as to the way that this newer product performs vis-a-vis the what we considered the kind of the traditional or the orthodox approach to it? So I don't think there's a technical barrier. I think there is to an extent there's a skills inhibitor or a limiter around that. And certainly from a UK point of view, the decisions that we've made in the past in terms of where we invest, in terms of retrofitting, let's go to a residential perspective. There have been decisions made previously from a policy perspective that we are now dealing with in terms of the amount of work that needs to be done. And your comments just now about just how energy inefficient some of our residential stock is partly a consequence of decisions that were made over the last decade or so. So there's definitely a kind of skills and capacity blocker. To an extent, there's an information and data gap, and then after that, it becomes, like so many issues of change, it becomes a cultural issue, and the way in which people are prepared to engage with new ways of working and new types of products, and switching out from what they're used to into things that are more effective and more efficient across the entire sustainability spectrum.
Super interesting. I think that's our final question, also given time. So thank you, Simon, and handing back to John.
Thank you very much, Daniel and Simon, for fascinating. Yeah, it feels like this area, along with Building Safety Act, which we haven't touched on today, will be big drivers of change. That will keep us, will keep the sector busy and keep all of us busy, in the years to come. So we're just going to quickly do predictions. I mean, mindful that we'd like a bit of time for Q&A at the end. So we're just going to do one each, actually. So Pete, should we go with you first? Your sort of thoughts for the next coming year? If you have one item that you'd sort of flag.
I think doubt, but the smaller deals will still be happening from a buy and build point of view, and there will be a theme for private equity to be selling stakes that don't trigger a refinancing requirement.
Okay, thank you. Noble, could we turn to you, please? If you're still with us, I hope you're still with us.
I hope so. From my perspective, I would have thought that private equity will be looking very much at demand medium term based around the fact that despite the dip this year, medium term, we're going to have to see new homes and a substantial increase in new homes over the medium term. And then the other key area is something mentioned in the most recent presentations, which is based around decarbonisation and energy efficiency retrofit. I am not as optimistic as Daniel around government learning on its schemes based around private housing. Energy efficiency schemes, government may learn from their failures of the Green Deal and the Green Homes Grant, but overcoming the issues of who is going to pay for the work to be done on the 16.7 million homes across the UK that is below EPC rated C, and so will have to be energy efficiency retrofitted, all individually, all bespoke. And who is going to do that work, I have concerns about. But the great opportunity is very much based around housing association and public sector housing and public sector buildings, because the finance is already there and that is going to be spent. Then primarily based around the commercial and industrial buildings, and that's primarily because that will occur because the MEES standards are put in place, and as Simon mentioned earlier, the investors are driving this. So I wouldn't base my business models based around government policies, except where there's specific finance, but I would base my investment decisions based around the fact that the investors are driving ESG, and that work is already occurring and will only increase medium term over time.
Thank you. Yeah, I guess we also see investors driving ESG, both in the public companies that we highlighted earlier, but also private equity as well, when their source of funds. Simon, can we come to you, please?
Yes, absolutely, John. And I'm just going to build on what Noble's just been saying there in terms of my predictions. So I think the tolerance for greenwash and all its guises, and it does exist in multiple guises, will drop away even further over the next 12 to 18 months. And that means that product claims are going to need to be substantiated with meaningful data and ideally supported with an appropriate level of assurance. And science-based targets are going to become an expected norm, both by end occupiers, external stakeholders, and to the point Noble was making there, from an investor perspective, we've seen it in other sectors. We've seen it in terms of different aspects of the development value chain as well. And so that means that the way that the building product supply chain contributes to the decarbonisation pathways will become really important. And that's partly because, of course, buildings represent a really visible, tangible part of organizations' kind of brand and reputation. So embedded carbon will become an important way of reporting. And that means that I think the kind of punchline to my prediction is that 23 into 24 we'll see increasing levels of expectation around reporting and transparency.
Can I just ask, is that, across all organizations, do you think? So small as well as large? I guess, definitely large, but do you think?
Well, if we look at other sectors too, what we see is different levels of adoption and paces of change. So change happens at different paces in different places. So the overall trend will be there, It's a little bit between, you know, climate and weather. So the climate is definitely moving in that direction. There'll be certain parts of the market that move more quickly than others, and that will be influenced by location, end users, counterparties, the value of the asset, and so on and so forth. But I don't think we've ever seen a consistent, you know, progression in any sector. So there's no real reason to expect it here. But we will see things moving in that direction, and people, you know, benefiting from getting towards the front of that curve, and other people, you know, playing catch up later, and so on. So, and that's not a size thing. There'll be large and small operating at different paces as well.
Yeah. Okay. Thank you very much. So Daniel, lastly, just if we could turn to you.
Yeah, I mean, I think a lot of the big trends that we've seen over the last few years are going to continue into 23, 24. So specifically, labor and skill shortages, the entire sustainability point, and regulation, and therefore, what that means is there's going to be more and ongoing investment and consolidation and rollout of a number of different themes and technologies. So I think modular is going to become ever more important, despite some headaches out there. Any of the sustainability type technologies, whether it's heat pumps, insulation, general energy efficiency measures for the home, will continue to grow, and as well as the more compliance side, so fire safety, wider security, testing and inspection. So I think all of those are going to become ever stronger and ever more interesting for investment and corporates alike.
Okay, thank you, Daniel. Yeah, no, very interesting. I definitely agree. Well, I'd agree with all of that, but modular, you know, which we maybe talked about a little bit less today, I think it's just going to be, you know, get bigger and bigger over time, despite the sort of market headaches that you've talked to in the short term. You know, I think long term that'll become a huge thing. So, if the panelists could just stay with us for the last couple of minutes, just in terms of Q&A, I think Matt has been sort of monitoring the chat to see if we've got any questions that have come in from people.
Yeah, thanks, John. So we've got two questions. One's a little bit more specific, but I think let's just look at that sustainability point. And this question come in specifically around M&A. So as we've all touched on, corporates are increasingly becoming more specific on their sustainability goals, commitments. And we've talked about those types of innovations. So the question, I guess, to you, John, is how important is M&A in corporates being able to meet those sustainability goals?
Yeah,
now?
I think it will become, you know, so if you know, we sold a solar powered lighting business to a large industrial group a couple of years ago, and that for them, you know, that was a listed group that they were, you know, very much part of the story that they were trying to tell to their investors, bringing that kind of capability into the group. So I think, you know, where M&A can bring you some capability in you know, in the sustainable area that you don't currently have within a business, that could be hugely important and attractive. You know, equally for people, owners of businesses looking to sell. I mean, you know, renewables, we're beginning to see more activity in that area where, you know, they can see the increase in demand and the sort of bottlenecks in terms of what they do. You know, and you know, this year, next year may not be a bad time to capitalise upon that.
Thanks, John. And then Noble, a question I think for you that's come out of your economic outlook. So you spoke about the demand for grade A office space and the conversion of towers. What about those towers that, let's say, aren't grade A? We talked briefly about stranded assets. How do you see those buildings either being utilised or otherwise in the short to medium term?
Thanks, Matt. That's a good question. There has been a 50% increase in the extent of vacant office space, and there is a big fear from a lot of commercial property owners medium term that some of that space won't be economic. It won't be financially viable to retrofit where it's old commercial office space, particularly where it's bought at very high prices when the commercial market was at its peak. What we're likely to see is that the vast majority of that will have to be refurbed to get it up to EPC rated C, and then in the medium term B and above by 2030. If it isn't, then it will have to be converted into other uses. And what we are already seeing is that some of the commercial space that isn't being converted into office space that is grade A, where the demand is strong, some of that is being turned into residential, and where it's not in urban centres, where it's just on the outskirts of cities, it's going to be converted into industrial logistics where the demand is very strong.
Okay, thank you, Noble. So look, we're just on the hour, so we should we could go on for some time, I think, with Q&A, but we should probably sort of stop it there. I mean, if people do have other questions, please do drop us an email. You know, I think you should hopefully have all of our contact details. If not, we'll make sure they're in the slides when they come around. So very happy to follow up on, you know, any other Q&A post this event. So I'd just like to say thank you very much. I mean, thank you to all of our panelists, you know, in particular to Pete and Noble for joining us as external speakers, and also to the people just behind the scenes who've helped put this together. So thank you for that. Thanks very much for joining us and listening, and for your questions. Just to remind you, a copy of those slides will come round along with the recording, and I hope next week we will be sending out a copy of the publication. So thank you very much, and we'll see you next time.